All right, guys. Well, thanks for joining us today. Appreciate you sharing your time with us and looking forward to having your questions and feedback today. If you want to unmute and open up your screen, we'll make this a very interactive session, and we're glad to take questions along the way. As I said, I'm Hall Martin. I'm the CEO of 10 Capital, where we help startups and investors connect for funding. And today we're going to talk about pitching for funding and how fundraising is like fishing itself. And I found that to be an apt analogy, and just wanted to, if you bring the right mindset to the fundraise process, you'll have a much better time than if you don't bring the right mindset. And we'll talk about that as we go forward. So with that, let's go ahead and kick off into our slides here. Let's open up and let's look at the first slide. And we call this how fundraising is like fishing because when you're fundraising, some approach it as an opportunity, and you get to meet new people, explore another part of the entrepreneur ecosystem. Other people look at it as a chore that it distracts from your real business. You really want to go develop products or close sales or create your own business. But the reality is that fundraising can be a very useful way to expand your business, expand your network, and meet new people and learn new skills. And the skills you learn in fundraising are very relevant to the rest of the business. Just like you need sales skills to close the customers and recruiting skills to hire people. So it's the very same skills that you'll be applying to investors who you want to invest in your business. And so what you want to do is look at this as an opportunity to hone those skills, build that network that you have, and bring more people into your business. Most entrepreneurs have a little bit of unrealistic expectation that when they go in, the idea is going to carry the day and everybody's just going to be bowled over by it. But the reality is, investors see many ideas, and be candid, they're really not all impressed by ideas. What they're impressed with is execution. And so every chance you have, you want to show how you are executing, not forecasting. So when you go to meet with investors, realize that just because you don't get a check doesn't mean it was a failed meeting. You met new people, you learned new experiences, you got new feedback, and that's all part of the process as well. So if we go to the next slide, I meet a great number of entrepreneurs and see many approaches to fundraising, but I think the best approach to think about this is when you approach fundraising, think of this like fishing. I often have people coming to me saying, here on June 1st, we will raise $1 million by August 15th, and they set that out there. The problem is, whenever you went fishing, did you ever sit down and say, it's 9 o'clock, by 10:15, I'm going to have 3 fish hooked? Fishing doesn't quite work that way, and so neither does fundraising. It's a little bit more of an indeterministic process that you have to go through. So the key is to bring your best game to the meeting and treat it like you would fishing. So let's look at next slide. The first thing I want to bring up is, in fundraising, it's show, not tell. If you tell me, it's an essay. If you show me, it's a story. Stories play better to investors. Essays, where you're describing things in just detail, can lose their attention, and you don't want to lose their attention. Next thing I always find is, some people don't want to tell me what they're doing now. They want to tell me what they're going to do tomorrow. They spend all their time on forecasts. But the reality is, I need to know where you are today as an investor. I need to know what you're doing now, what you're executing on now, to get a baseline, and then forecasts can sit on top of that. But without a baseline, it's very hard for investors to really understand what the forecast means. Because what they're trying to do is go from here you are today at this point, and here's where you'll be tomorrow, and they're drawing a line from one to the other. And if they can get comfortable with that, then they're going to look for, go down the path toward investing. If they cannot get comfortable with that, you've lost them. They're not going to go forward as an investor. So never show up to an investor meeting or call without something new in hand to show the investor, to demonstrate that execution that you have going. My rule is, you should always talk about a customer and their engagement with your product or team. Even if you're pre-revenue, even if you're in the idea stage, you should be bringing a potential customer to the table. We were talking to IBM. They had this problem. We brainstormed. We think we can solve it. Next one is, we've actually built a prototype. IBM says they want to buy it. They want to use it. This type of engagement with the customer along the way warms the investor's heart, because it shows You're in touch with the market. You're in touch with the customers. What they don't want to hear is we're building a product. We haven't shown it to any customers. We have no revenue, and we don't plan to turn on revenue. We just plan to build this product to the nth degree, and then we're going to show it to customers, because they get very scared that you may be building the wrong product. So always bring customers into it. Next is demonstrate how the team is making things happen. Mention what your team members are doing to move the ball forward with closing sales, generating leads, building the product, etc. And then next is show how other customers are committing funds to it. If you have interests, commitments, or investments, list all three of those to investors that you're talking to show that they're not the only ones in here. Others are in here, and that gives you validation and proof that you're building something that other people are finding interesting. And finally, show how the product is working and what it's doing for the customer today. Show customer ROI, show what customers are saying about it. Again, tie product and customers back into the reality of your business so that you can demonstrate you are executing. Things are moving forward at some level. So it's a great way to get out there and, like I say, show, not tell. If we go to the next slide, read the water. Just like you do in fishing, perform as much diligence on the investor as they are performing on you. Know as much about them as they know about you. Investors follow a common funding strategy in a school-like manner. Get a sense of which way they are going and adjust your deal and approach accordingly. If you're positioning your deal as a service or a product and nobody's understanding it, well, then maybe reposition it as a more compelling business model like recurring revenue, and emphasize you have a repeatable, predictable business going there and get people back engaged with you. So read the room and make sure that you're in touch with them, and realize there's more than one way to present a deal. It's not just about the product or the service or what have you. It can be about the business model. It can be about the space you're in. It can be about the social impact you bring. There's many ways to lens into it, and you're trying to find that connection with the investor itself. So on the next slide, as in fishing, be patient. You have to set the bait and wait for the right fish to come along. You'll go through many fish that will come by that will not be the right person, but you're looking for that right one. And you just have to be out there in the market meeting people to find the right ones that fit your deal and are a good match for what you're trying to do. Just like you can't rush a fish to the hook, so you can't rush an investor to invest. You have to take it one step at a time. And if you're not getting luck with this group, we'll move to another location. Just like if you're not getting any bites in one place, move to another part of the pond to see if you get some better bites that go into it. And next is, last slide is, it will take you 1 calendar year for every $1 million you're trying to raise at the seed level. And so to level set how long it takes to raise money, most people come in with very unrealistic expectations. I'm going to raise $1 million. It'll take me 2, 3, maybe 4 months, and I'll be done. The reality is, you'll spend a month or two just putting the documents together. You'll spend another month or two getting the initial investor calls going. You'll spend another month or two getting into the angel groups and the VC funds you want to be into, and it's going to be a year. And so think about breaking your fundraise down into smaller steps, and make sure that you're preparing for this before you go out, so you have your documents ready when you go see them. And it also takes a month to close. People have to do diligence. They have to sign term sheets. They have to have attorneys review it. They have to go through diligence boxes. They have to wire funds. Oh, by the way, they're busy with other projects, so you're not the only thing that they're working on. So realize it takes a little bit of time to go through this process. After you close investors, you'll need to find yet another round of investors and repeat the process again. So you'll be going through these cycles where it's taking 2 to 3 months per investor group to go through, pitch, walk them through the process, educate them, build a relationship, close the funds, and then go to the next group as well. You can do some things overlapping, but for the most part, it'll take you some time to get through all of it as well. The next slide is be flexible. I see entrepreneurs setting those specific time schedules out there. This is the same as casting line and saying by 3:25 we'll have our first fish. The fish rarely work on your schedule, and investors won't either. And that's one thing you have to think about. The investors are on their schedule. I'm on mine. I really can't change their schedule. I have to work with it. And so you can always throw a stick of dynamite in the water to expedite the fishing process, but this is kind of where the fishing analogy ends. You really can't throw a stick of dynamite in there to get the investors to move faster. They're going to go at the rate that they're going to go. And so we have to be careful with that. And so in conclusion, fundraising is like fishing. It can be a fun experience or it can be a terrible one. It just is how you perceive it. And it takes the right place with the right bait and the right patience in order to actually catch a fish. And so it's the same for finding an investor. For every 10 prospects of investors, you'll get 8 no's, 1 maybe, and eventually 1 yes. You just have to stay with them all till you figure out which ones those are. Fast no's are appreciated because they're off the list. We can move on to the next one. And so my advice is just keep going till you hook the right one and go from there. So let's stop there and let's see what questions people have. If you have a question, you put it in the chat box. If you would rather just open up the mic and ask me directly, you can as well. What do you guys think? Here's my chat. Is anybody here raising funding now? Yes, John. Tell us about your fundraise. You're on mute. If you want to unmute, just tell us all.
Sure. We're looking to raise a seed round right now. We've been building a AR app that allows essentially you to put augmented reality into any live event. So of course, during COVID, that was the worst possible business to be in. So in the meantime, we actually went and took that same platform and used it to build sales tools for companies that weren't able to reach their customers during that time. And so now that we're coming out of COVID, we're looking to raise to actually go after this event space sort of thing. So it's a little bit of an interesting proposition. We've got great customers on the business sales app, but we're only now starting to get customers on the event side, which is what we think is the real growth business that we're trying to sell to investors. So that's our challenge as we approach this. When you're saying, hey, show that you've got customers and things like that. Well, we don't, because COVID didn't allow us to get that, but we have been successful in this other part of the business. So that's kind of what we're going up against.
Well, that sounds like a two-sided market there. On one side, you have supply. The other side, you have demand. And the supply side, I find, can be easy to build with just scraping and emailing and building the list. But on the demand side, that's the hard part, because they're the ones that are paying for it, and it takes time to sign them up. The key is to go in and show that we have built the supply side of our business. So you've got this inventory built up already. That helps a lot because it shows you built a big part of it. And then on the demand side, you don't have to have hundreds of people. What you really need is 2 or 3 very excited people. So if you can just show those 2 or 3, that right there is substantial traction for investors to say you've got both sides of this equation. And the thing I always say is, it's not the absolute number that's going on here that investors look for. It's a startup. It's not going to be big numbers. Signing up those demand side people, we do these 3 steps and we can get people signed up. That's what investors want to know, is what's the system behind it and how repeatable and predictable is it? And if you have that, that's what you emphasize in the investor side of it to show that you have it. We often play the unit economics story at this level. It's not so much, you may only have 5 people signing up, but what was the cost of signing up those 5 people? And if those are compelling numbers with cost of customer acquisition and lifetime value, if those are compelling numbers, tell that at the unit economic level, not at the macro level. So did you have any specific questions for us at this point?
Yeah, I mean, obviously going after seed, the expectation is that you're not quite full revenue on the idea, and market fit data may not be there. But I'm also finding that investors are still expecting a lot of that data, even at a seed level stage. How do you kind of get around that? I mean, that's That's data that you normally expect to be fully, very tangible at a Series A and beyond level. But at seed level, there's, from everything I know, there should be some expectation that, yeah, the data is not complete. There's more risk, but there's also, you're getting in much earlier because we've been able to show you that we think this idea is going to work. This money is going to help us go prove that it works.
Right. Well, if you have a beta and you can do multiple cohorts, that's always compelling. Every month you're coming out with another 5 to 10 users, and here's what they said about the price. Here's what they said about the features they want, and here's what they said about how much they're going to engage with it. And after you do 2 or 3 of those, you start to see a convergence of numbers. The price starts to converge as to what they'll pay. The sign up is starting to converge as to how many will use it on the other side. And so you can use beta cohorts to try to fill in for the fact that you don't have hundreds of people signing up paying for it yet, but the answers are starting to become clear: what you charge for it, which is now going to be part of your lifetime value, and then what's your cost of customer acquisition, because you're dealing with them. You can start to figure out what it took to get them into beta, and so that becomes a number plugged in. So you start to fill out and strengthen your unit economic story when you do that. And even though those are not fully paying customers in some cases, it's still meaningful information for them, for the investor as well. They can start to get comfortable with it because it's the repeatability. They say it takes 7 touches to close a sale, so it takes 7 touches to close an investor. And multiple beta cohorts and other things can count for those 7 touches. They start to become familiar with it. They see you in action. They build a relationship, and now they're ready to invest. And they may not invest a lot. You may not need a lot at the early stage. You may need just a little bit to get it going, and then you can raise more later as well. But Cindy,
Okay.
Mark, anybody else have any questions?
Paul, we've got some questions queuing up in the chat box there.
Okay. So what's the difference between angel and seed? Angel, seed, Series A, B, and C, and are there investors that target each phase? So basically, the stages of fundraising are seed, Series A, and Series B. There's also something called pre-seed. In my mind, pre-seed is when you have 2 people with an idea and they're looking for money to go test it. Seed is when you are building your beta unit and you're trying to build an MVP and try to get proof that the market will pay for it and so forth. And seed raises are pre-seed are typically 250K raises. Seed are 500 to 750K raises, and Series A are 1 to 1.5 to $3 million raises. And Series A means you've got 200 or 300K of revenue, you're growing strong, and you're starting to see repeatability and predictability in the business. And then Series B is later stage. You have $3 million of revenue, and you're trying to raise $5 or $10, $15 million of funding to carry it forward. So it just goes to show which stage you're at. That tells the investor, this is the price I'm at. It's important to know that because you can actually research investors and get a sense that what stage do they invest in. If they don't do pre-seed, then it makes no sense if you're pre-seed to go talk to them. And you can focus your efforts if you really start to analyze the investors out there. On Crunchbase, you can download the list of investors and start to do some of that analysis work itself. The angel, venture capital, family office, this is the type of investor, not stage. An angel is an individual that's investing their own money. A venture capitalist is someone who's raised money from other people into a fund and basically is managing other people's money into a startup investment. And a family office is like an angel. It's their own money, but they may have a substantial amount, and so they've actually assigned someone to actually manage the fund for them. And actually, it may not be a fund; it just may be investing off the family balance sheet. So, and they all work a little differently. VCs want 10x home runs. They've got a high hurdle rate. It's got to be 10x or more. Angels, they're looking for 3 to 5 times their money in 3 to 5 years, and what they look for is that there's execution, there's proof of work here, there's traction, because they just don't want to see the deal go dead because it was just a bad idea. And then family offices are, they're patient money, and they can last a long time. They're not tied to the 10 years life cycle that VCs are with their fund. And so, but they can write bigger checks too. 250K is what VCs write, what family offices write. VCs write 150 to 500K checks on the first round. And angels, on most cases, are writing 25 or 50K checks. And then you also hear the term high net worth individual. It's like an angel that has more money, and they're usually writing 100K checks. So that answers that question there. If you have any more, let me know about which ones you're looking for. And then the next question is regarding demonstrating other investors are interested in the deal. What investor information should the entrepreneur divulge? Investor name, investor contact, amount investor has invested or pledged to commit. What if the entrepreneur has a term sheet from an investor who has not committed yet? So if you're talking to investors and you want to mention other investors, all you really need to know is say that I've got, I'm raising 750K. I've got 100 invested so far. I've got 250 committed, and I've got another 150 interested in it. And so interest means I'm thinking about 50K, committed means I'm going to put in 50K, and if 50K is in your bank, that's now invested. So you want to start with that level to show all three levels of support you have on the fundraise. And then what you want to do is, if you have a lead investor, you go to them and say, hey, can I use your name with other investors? If they say yes, well, then you say, so-and-so is a lead investor of our deal, and he's happy to share with you information. That may be for investors who are in the interested, committed phase. And so as people get further into the raise, you can give them more and more exposure to your current investors. When we run webinars and online campaigns, what we find is the most effective is the Why I Invested webinar. And having your investor come on and do a short, 15-minute Zoom call that you record, you do a short pitch, and here's what the deal is about. You have the investor come on and you ask, well, why did you invest, and what was your experience, and what do you think is the best chance of success here? What do you think is the challenge we face? And other investors really appreciate that because they're getting the benefit of another investor's experience. The other thing that they will do for you is it shows your team is much bigger than they thought. Most time it's the CEO going out to pitch. They can look like the Lone Ranger. There's just one person there. But when we do these Why I Invested webinars, what I find is there's 3 or 4 investors behind them, and oh, by the way, they're all doing something to help the business. So the team is now 4 times bigger than we thought it was. And oh, by the way, I like these guys. I want to be a part of it. And you'll find that when you're mailing, most of the stuff is going through email these days or online. The deck and those things are very good about communicating the quantitative information, what we do and what our revenue is and so forth, but it doesn't really show who the people are. And I think building a little bit of that relationship is a key part of raising funding. And if you can do some Zoom recordings of the team, the board, or the investors, that goes a long ways toward showing here's the kind of people we are. And if you want to join a group like this, well, this is where you invest. And when people see that and say, hey, I want to be a part of that group, they're on the path to putting money in for that. So that goes to that one. So you should ask for permission before you put investor's name out there, though. And the last question is, what if the entrepreneur has a term sheet from an investor who has not committed yet? Then what you say is, we have term sheets. You don't say you got funding. You just say, I have term sheets from investors. And that means they're in diligence. That's a very common thing, but that shows interest. And like I say, I always want to show what values are in the business so far, and investors that are circling the deal, that's a value. Investors doing diligence, that's a value. And you want to put that out there to get credit for that. Doesn't mean they have invested, because it's oftentimes they'll give you a term sheet, you're analyzing it, you're researching it, they're doing diligence. And, all of this is, even if they've signed it, it only works if they transfer the money in. And most term sheets list it that it's valid upon, passing due diligence. And due diligence can take some time, and it can fall apart too. I have people coming in saying, oh, I just found my lead investor. Therefore I'm shutting down my fundraise. I'm done. And I always tell them, well, you always go till the money's in the bank. I've seen these deals blow up that the 50-yard line, the 40-yard line, the 30-yard line, the 20-yard line, the 5-yard line, the 1-yard line, the 1-foot line. And they can always blow up before the money gets there. So never stop raising funding, keeping investors up to date until the money's in the bank, and then you can decide where to go from there. What other questions do people have? Anybody else? Emily and Andre, anybody else want to ask any questions? Feel free to put that in the chat box or unmute, and let's hear what you guys have to say. We have a couple of minutes left here before we go. If some of you want to hang around for a few more moments afterwards, we'll be glad to answer those as well. Cool. Well, if you guys ever decide you need help with your fundraise, we have what's called funding as a service. Basically, that is, we are helping startups raise funding. We basically run investor relations and introductions. We help you connect with investors. If you need help with documentation, pitch decks, or data rooms or so forth, we'll help you put those together. And then what we do is introduce you to our investors through email. Those expressing interest, we set up calls for them to talk with you, and then we're going through the process. What I always encourage entrepreneurs to do is, whenever you're raising funding, write down the name of people that you pitched and send them updates every so often, once a month, short email showing progress on 4 areas: the sales, the team, the product, and the fundraise. In the first pitch, it's always great to say, here's how big the market is, here's who our competitors are. But after that first meeting, investors don't care about those things. What they care about is what you are doing. So always emphasize your traction, your performance, your execution on sales, team, product, and fundraise, because that's the part that shows you're executing. And at heart, where they're looking for a growth story that shows momentum and traction in there as well. Got a couple more questions before we wrap up. Would you invest in convertible preferred? Yes, I think that's a valid way of going. We start with convertible notes all the time. It's a great way to kick off a fundraise. If you're in the early stage, pre-seed or seed, it can be hard to settle on valuation because it's so early. Convertible notes and safe notes are such that we're really not setting the valuation, but there are a lot of people that want to be in the deal, but they're not going to put the valuation on it or do the diligence or set up the deal structure for an equity term sheet. And so I always say, don't make the investor climb the valuation wall on day one. Let's start off with something simple. Hey, put in 50K, be a part of the deal. And we go till we find somebody that wants to put in 100 or 200K, and they really want equity. Well, they're the ones that will sit there and figure out the valuation and help you set the term sheet. You're just waiting, just like fishing, you're waiting for the right investor to come along to be the lead investor. But there's a lot of other people that will want to be in the deal without having to do too much work up front. And next question is, are you industry agnostic? I would say our database of investors is 50% tech, 25% healthcare, 25% consumer product goods. We do look for venture level deals. They're scalable. They can reach large markets. But in general, we're not. We are industry agnostic, but it has to be in the world that it can count for venture. If you like to talk with us, go ahead and look us up at 10capital.group or shoot me an email, and we'll be glad to set up a time to talk about your fundraise. Thank you guys so much for joining us today. We'll go ahead and close the webinar now. If anybody has any questions, you can catch us up afterwards. It was been a good questions, and thanks so much for joining us with this. Appreciate it.